Hello there, how are you? Welcome back to my channel, Mr. Mash here. I hope you're enjoying economics. Today we are going to take a look at the theory of the firm. So this topic is really not that difficult. So it's something that from an exam perspective you should be able to get a lot of marks from. All right, let's get straight into this. The theory of the firm talks about the behavior of the firm. And we know that when you start a company, the idea of you starting a company is because you want to make money. We look at this making of money from two perspectives. Either the firm wants to maximize its profit, so the firm wants to maximize its profit. I'm going to use the symbol pi to represent profit standard in economics. Or to maximize profit, the firm can actually take an approach of minimizing its cost. So this cost, it wants to minimize all of its cost, which are the total cost. And hence, the profit of the firm is given by the total profit, the total revenue, which is the amount of money coming in, basically just the price times the quantity, minus the total cost for the firm. These total costs in economics are split into two. So the total cost in economics are split into two. They are either implicit or plus explicit. All right. The implicit costs are the opportunity cost. So you're looking at the cost of your foregone alternative. That's what your implicit cost is. It's basically an opportunity cost. So think about implicit cost as opportunity cost, alternative, the best alternative that has been foregone. In your explicit cost, these are your direct costs. These are the direct costs. Think of this as accounting costs. Anything you can see on an accounting income statement, for example, is going to be an explicit cost. Things like the cost of labor or the cost of electricity, etc. These are explicit costs. These are direct costs in production. All right. So now, when we consider the cost of a firm, we are basically going to look at whether the costs are made in the short run or in the long run. All right. So there is a difference between the long run and the short run in economics. Basically, in the short run, we are looking at a period in which a firm can incur fixed costs. So the short run, it's a period at which at least one factor input is fixed. And usually the fixed factor input in the short run is capital. And we use the letter K to represent capital. So at least one factor input is fixed. So in the short run, you are going to experience what we call fixed cost. I'm going to get into detail with that. But in the long run, all factor inputs are variable. In the long run, everything changes. We have enough time to change our capital. We have enough time to invest in new buildings, new machinery, and so forth. So there is that difference. All right. So one important thing you must take note of when you move into the long run is what we refer to as the normal profit. The normal profit. Okay. So the normal profit, basically, you are looking at the amount of profit an economy is making that gives it an incentive to continue operating in the long run. So it gives them an incentive to continue operating in the long run. In this instance, the firm would have taken the alternative use of its resources. So they take into account opportunity cost. Hence, your normal profit basically implies that the total cost of the firm is equal to 0. So it basically means that the profit of the firm, economic profit, is equal to 0. So this normal profit implies that the economic profit is equal to 0 after taking into account both implicit and explicit costs. You're going to have an economic profit of 0. That's what the normal profit is. All right. So your costs in the short run, like I said, are going to include, so SR means short run, take note of that, are going to include your fixed costs. And your fixed costs, FC means fixed cost. These are costs that do not change. Fixed. Do not change. They are fixed. So regardless of your output, for example, your rental, whether you decide to produce 0 units or 10,000 units in a month, if the landlord is charged you $5,000 a month, you pay $5,000 a month regardless of output. VC stands for variable costs, and these variable costs are entirely dependent on the level of output. These are entirely dependent on the level of output. So the more output you produce, the higher your variable cost. So these depend on output. All right. So these depend on output. Hence, the total cost would then be equal to the fixed cost plus the variable cost. The total cost would then be equal to the fixed cost plus the variable cost. That's the total cost. All right. Now, the average cost is simply the cost per unit. The average cost is simply the cost per unit. For instance, if you calculate the average total cost, let's say you're calculating the average total cost, this is simply the total cost over the number of units produced. Or if you calculate the average fixed cost, is just the total fixed cost over the output. So it's how many fixed cost are you incurring? How much in fixed cost are you incurring per unit of output that you produce? All right. And then there's what they refer to as the marginal cost. The marginal cost is the cost that you incur. So that is the change in total cost when you produce an additional unit of output, which is the change in output. When your output changes by 1 unit, when you produce 1 extra unit, by how much does your total cost change? All right. So this to get this, you're simply getting the total cost after producing an extra unit minus the previous total cost. You divide by the quantity 2 minus quantity 1. So this is how you calculate the marginal cost. All right. So what I'm going to do is I'm going to go through this cost in the short run using an example. Look at this table. You can try to fill it up by yourself, but I'm going to go through this with you, and I'm going to use a red color so that you can see what I'm doing here. Okay. Your total cost here is 80, which for an output of 0, remember your variable cost, this is total variable cost, it depends on the level of output. So for an output of 0, you don't incur any variable cost, but the total fixed cost, it doesn't change. Remember, the total cost is given by the total fixed cost plus the total variable cost. So if the total cost is given as 80 and the total variable cost, we know for an output of 0 is 0, this means the total fixed cost has to be equal to 80 as well. Okay, you fill in here, you have 80, so the total fixed cost is 80. And I think just fill in this part. Remember, we said fixed costs, they don't change, they're independent of output. So the fixed costs are going to be 80 for all levels of output. So when we get here now, the total cost here, what I'm going to do, let me use letters and put the formulas here so that you can refer back to the formula here. Let's say this is A. To get A, what we do is we add the total cost is equals to the fixed cost plus variable cost, this formula here, which is equal to 80 plus 40. We get 120 here. All right. And then we come here, the average total cost B. So the average total cost is just, remember, the total cost over the quantity. For B, the total cost is 120, the quantity is 1. So the average total cost is also 120. And then you can use this formula to get the averages as well. There are many approaches of doing this, but you can use this formula to say if the total cost is equals to the total fixed cost plus total variable cost, then the average total cost is equal to the average fixed cost plus average variable cost. Okay, which means if we can use it when we come here. Okay, we can use it when we come here. The average variable cost is simply the variable cost over the quantity, 40 over 1, which is 40. So to get the average fixed cost based on this formula, you're going to simply say 120 minus 40. You're going to get an average fixed cost of 80. Okay. Alternatively, for this, so I'm going to code this C and show it here. Alternatively, to get the average fixed cost, you can still do it like this, to say for C, the average fixed cost is equals to the total fixed cost over the quantity. Total fixed cost is always 80. The quantity in this instance is 1. 80 over 1, which is equal to 80. That's how you get that. All right. And then let's proceed to this part here. You have a fixed cost of 80 and you have an average variable cost of 38. All right. Now, remember the average variable cost. Let me call this. I'm going to call total variable cost D. Let me call it D. So D here, the average variable cost is equal to the total cost over the quantity. Right? Now, to get it's the total variable cost over the quantity. We are given the average variable cost is 38. This value is given as 38, which is equals to the total variable cost over the quantity. Now it's 2 here. We divide this by 2. Then we cross multiply. We say the total variable cost is equals to 38 times 2. Then when you multiply 38 by 2, you must get 76. That's how you get D. So D, we get 76 here. Okay. And then we're using this formula here where we are saying the average. Okay, let's start by getting the average fixed cost. The average fixed cost is straightforward because the average fixed cost is simply going to be the average fixed cost is the total fixed cost over the quantity, which is the total fixed cost is 80, it doesn't change. The quantity in this instance is now 2. We divide this by 2. If we divide this, we get 40. So this is 40, right? And we can call this E. This is E. It's 40. So to get the average total cost, we can add 40 plus 38, which should give us 78. It should give us 78. And then to get the total cost, remember it's just the fixed cost 80 plus the variable cost. If you add these two, you must get 156. This must be easy for you now. And then we go down here. We now go to this part here. Now, the marginal cost, remember, the marginal cost is the change in total cost over the change in quantity. These values, the average values you can't get, you can't divide by 0. So these values, you cannot calculate this. You can leave them blank. And then, but for this first marginal cost, it's going to be the total cost at 1 minus the previous total cost, the total cost at 0, divided by the quantity at 1 minus the quantity at 0. Now, we don't have this, so the marginal cost at 1, total cost at 1, it's 120, minus the previous one at 0, it's 80, divided by the quantity 1 minus 0. So this is always going to be 1, the change in quantity, because our quantities are increasing by 1. So take note that the change in quantity in this table is always 1. Hence, when we subtract 120 minus 80, we should get 40. Hence, for f, let me call this f. This is how we get f. We eventually get an answer of 40. All right. We do the same thing for this part here. For an output of 2, we say 156 minus 120, we get 36. When we get to 32, we have this 32 is given the marginal cost. The marginal cost for an output of 3 is equals to 32, which is equal to the total cost at 3 minus the total cost at 2. Hence, the total cost at 3 is equals to the total cost at 2. This becomes a plus if it crosses here. Total cost at 2 plus 32, which is equals to 32 plus 156. 32 plus 156 should give you an answer of 188. So it must give you 188. Just confirm these answers. 188. All right. And then the variable cost is simply using this formula here. The total variable cost is the total cost minus total fixed cost. 188 minus 80, it must give you 108. And the average total cost is 188 divided by 3. It's 62.67 to 2 decimal places. The average variable cost, the variable cost is 108 divided by 3, must give you 36. Then 62.67 minus 36, it must give you 26.67. Alternatively, you could take the fixed cost of 80, you divide by 3, it gives you the same answer of 26.67. It must be the same. When you get to the last part, you have an average total cost of 58. How do you get the total cost here? Let me call this G. To get G, it's the total cost at 4, right? The quantity is 4, which is obviously the total cost at 4. To get that, we give the average total cost which is given, and this is equal to the total cost at 4 divided by the quantity 4. So we cross multiply. We are going to have 4 multiplied by the average total cost of 58. If you multiply 4 by 58, you must get a total cost of 232. And then 232 minus 80, it must give you 152. Okay, it gives you 152. And then the average variable cost, you can divide the variable cost 152 divided by 4. This must give you 38. And if you subtract 58 minus 38, it must give you the average fixed cost of 20, or 80 over 4 still gives you 20. The last one, 44, remember, it's the change in total cost over change in quantity, which is 232 minus 188. It must give you 44. That's how you fill in this table. So this is not overly complicated. When you get stuck somewhere, pause the video, give it a try, come back, take a look at these formulas. It does look a bit hectic, but trust me, it's not. I hope you enjoyed this session. Mr. Mesh is out, but in the meantime, enjoy economics. Cheers.